Hi, this is Barry Habib from MBS Highway. Quite a bit of activity in the mortgage markets. We've seen, of course, this big move up in rates. Now things have calmed down a little bit of late. A lot of this has had to do with Ben Bernanke, who's sort of gone rogue on us. The prepared statements over the last couple of months from the Fed have been pretty much in line, but Bernanke introducing some concepts as far as trimming down the amount of quantitative easing and bond buying over the next few meetings really spooked the markets. In fact, his comments saying that he'd like to be at least started with it before the end of the year and done with quantitative easing before the middle of next year had sent some shockwaves through the interest rate environment. Now, what we need to know is, let's understand what QE means, quantitative easing. The Federal Reserve is purchasing $45 billion every month in long-term treasuries, along with another $40 billion every month in mortgage-backed securities. That's $85 billion a month. Quite a bit of money, and this has really been supporting the bond market. What very few people know, though, is in addition to this, the Fed is saying that they are going to roll over principal payments and refinance payments of existing mortgages that they're holding. So the Fed's already holding so many mortgages that they bought through QE1, QE2, Operation Twist, QE3. And if you do a refinance for somebody and that loan pays off, if the Fed's holding it, what the Fed is then doing is taking that money and buying more mortgage-backed securities with it. In addition to that, every month when people make their principal payments, the Fed collects that money and they're reinvesting that by buying more mortgage-backed securities. So in reality, when the Fed says they're buying $40 billion a month in mortgage bonds, it's really been closer to $70 or $80 billion every month in mortgage bonds. So a big fear is when the Fed stops this or does the taper, what's going to happen with these rollovers? Nobody knew until yesterday. Or when Ben Bernanke tells us now that as far as these rollover payments, they will remain in place even after tapering begins. So he's not going to taper these, and even when he's done with tapering, they're not going to address the rollover portion until they start hiking interest rates. Now, when will they hike interest rates? So far, the Fed said that the unemployment rate needs to reach at least 6.5% from its current 7.6%. That's a long way off. In addition to that, it's my feeling that as we approach 6.5%, the economy is probably not going to be on as steady of a footing that the Fed would like. More than likely, we'll see them reduce that target to 6 or 5.5% on the unemployment rate. The Fed's already dropped some clues saying that the rate of unemployment probably overstates the health of the labor market. So, this is good news for mortgage bonds. This is good news longer term for interest rates, at least for the next couple of years. Doesn't mean that rates aren't going to go up another leg. They certainly could. But some of the damage that we would have seen in interest rates is contained and curtailed because the Fed's going to continue to support mortgage buying with these rollover payments. Hope you have a great day, and check out mbshighway.com. We provide you with the best information and data on this every single day. Bye-bye.